In March 2020, as the pandemic sent unemployment to levels unseen since the Great Depression, something extraordinary happened. While 22 million Americans lost their jobs in 2 months, the combined wealth of American billionaires grew by over $1 trillion, a 39% increase in less than a year. This wasn't an accident or a coincidence, but the latest iteration of a pattern that has repeated itself throughout American economic history. Every major recession in the last century has followed the same hidden trajectory. Ordinary citizens lose homes, jobs, and savings, while a small group of financial elites emerge from the wreckage substantially wealthier than before. The system isn't broken. It's working exactly as designed. Economic crises don't destroy wealth. They transfer it. When markets collapse and panic spreads through Main Street, a well-positioned elite class converts chaos into unprecedented opportunity. The mechanism operates through 3 distinct phases that replay with mathematical precision during every downturn. First comes the asset fire sale, where desperate families and failing businesses sell property and holdings at a fraction of their value. Second arrives the government rescue, where public funds backstop financial institutions, while ordinary citizens receive minimal support. Third emerges the recovery phase, where those who purchased distressed assets ride the market rebound to extraordinary profits. This pattern reveals itself most clearly when examining wealth concentration statistics across crisis periods. In 1929, before the Great Depression, the top 1% controlled 44% of American wealth. By 1933, despite or because of the economic collapse, they still held 33%. Today, after multiple financial crises, including 2008 and 2020, the top 1% controls over 30% of national wealth, while the bottom 50% holds just 2.5%. The system perpetuates itself through a critical advantage that separates winners from losers during recessions. When markets crash, those with capital reserves can purchase assets at depression prices, while those without reserves must sell at those same devastating valuations. This forced liquidation becomes the mechanism through which wealth flows upward, converting widespread economic pain into concentrated financial gain. The pattern repeats because the rules reward those who can wait while punishing those who must act immediately. The most instructive example of this pattern emerged during the 1930s, when the mechanisms of crisis profiteering became starkly visible. The 1929 stock market crash didn't happen to everyone equally. Some saw it coming and positioned themselves accordingly. Joseph P. Kennedy, father of the future president, recognized that stock valuations had far exceeded underlying company values and began selling his positions throughout 1928 and 1929. Kennedy's wealth grew from $4 million in 1929 to $180 million by 1935, a staggering increase during America's worst economic disaster. He achieved this by short-selling stocks during the crash, betting that prices would fall, then purchasing distressed assets at rock-bottom prices. Percy Rockefeller and William Danforth employed identical strategies, making millions while breadlines stretched around city blocks. The mechanism that enabled this wealth transfer had powerful advocates in government. Andrew Mellon, Treasury Secretary under President Hoover, and one of America's richest men, reportedly advised, "Liquidate labor, liquidate stocks, liquidate farmers, liquidate real estate. Purge the rottenness out of the system." This philosophy ensured that failing businesses and struggling families received no government support while the crisis ran its course. Mellon's approach had predictable results. 80% of American families held virtually no savings by 1929, and the Depression destroyed what little remained. Meanwhile, those with capital bought entire industries. According to the Brookings Institute, the top 0.1% of Americans in 1929 had combined income equal to the bottom 42% and controlled 34% of all national savings. The pattern was complete when recovery began. Those who had purchased stocks, real estate, and businesses at depression prices rode the eventual recovery to unprecedented wealth. The crisis hadn't destroyed value. It had concentrated it, transforming the capital structure of American society while leaving the majority of citizens permanently poor. The Great Depression proved that economic catastrophe for millions could simultaneously create historic opportunity for those positioned to exploit it. The 2008 financial crisis revealed how the extraction mechanism had evolved to include government as an active participant. When the housing bubble collapsed, major banks faced potential insolvency from their risky mortgage securities. The federal response established a new template for crisis management that would prove extraordinarily profitable for financial elites. The Troubled Asset Relief Program authorized $700 billion in taxpayer funds to stabilize the financial system. Banks received $236 billion in direct capital injections, while the Federal Reserve provided trillions more through emergency lending facilities. The total commitment reached approximately $7.77 trillion when accounting for all Fed programs and guarantees. Here's where the pattern becomes crucial. Banks that received bailout funds returned to profitability remarkably quickly. By 2012, major institutions like JP Morgan Chase and Goldman Sachs posted record earnings. The government eventually recovered its TARP investment with a modest profit of $15.3 billion. But this headline figure obscures the real wealth transfer that occurred. While banks stabilized and then thrived, homeowners received far less support. 9 million families lost homes to foreclosure between 2006 and 2014. This created the perfect conditions for the asset fire sale phase of the extraction mechanism. Private equity firms recognized the opportunity immediately. Blackstone launched a $13 billion fund specifically to purchase distressed real estate assets in 2012. The firm ultimately acquired over 80,000 single-family homes at depression prices across markets hardest hit by foreclosures: Florida, Arizona, Nevada, Southern California. What had been owner-occupied housing became institutional rental properties, permanently converting a generation's wealth-building opportunity into income streams for Wall Street. The numbers tell the transformation story. Home ownership rates fell from 69% in 2004 to below 63% by 2016, the lowest level in 50 years. Institutional investors who purchased foreclosed properties during the crisis increased rental income while property values recovered. Blackstone's real estate portfolio, negligible before 2008, grew to nearly $300 billion by 2023, with real estate accounting for half the firm's earnings. The Federal Reserve's response accelerated this wealth concentration through quantitative easing. The Fed's balance sheet expanded from under $1 trillion in 2008 to $4.5 trillion by 2014, accomplished by purchasing government bonds and mortgage-backed securities. This injected liquidity into financial markets, raising asset prices, particularly stocks and real estate. Research from the New York Federal Reserve found that quantitative easing reduced inequality among the bottom 90% by lowering unemployment, but widened the gap between the top 10% and everyone else. Those who owned significant financial assets saw their wealth multiply, while those depending on wages gained modestly. The mechanism had achieved maximum efficiency. Government policy directly inflated assets held predominantly by the wealthy. The COVID-19 crisis of 2020 demonstrated how the extraction machine now operates at unprecedented speed and scale. When lockdowns began in March 2020, the Federal Reserve responded within days, announcing $700 billion in bond purchases on March 15th. This number would prove to be just the beginning. Over the following months, the Fed's balance sheet more than doubled, expanding from $4.3 trillion in March 2020 to $8.9 trillion by May 2022. This represented the fastest monetary expansion in Federal Reserve history, dwarfing even the 2008 response. The mechanism's efficiency had improved dramatically. Asset prices rebounded not in years, but in weeks. The stock market bottomed on March 23, 2020, then began a historic rally. By the end of 2021, the S&P 500 had gained over 100% from its pandemic low. This extraordinary recovery happened while unemployment remained elevated and millions of small businesses closed permanently. The divergence between financial markets and economic reality reached levels that strained credibility. Billionaire wealth told the story precisely. According to data compiled by multiple sources, including Oxfam and Forbes, global billionaire wealth rose from $8.6 trillion in March 2020 to $13.8 trillion by November 2021, a gain of $5.2 trillion. The world's 10 richest men more than doubled their fortunes from $700 billion to $1.5 trillion, accumulating wealth at a rate of $15,000 per second. The mechanism operated through familiar channels. As small businesses failed and workers lost income, private equity firms raised enormous distressed debt funds. According to industry reports, firms had accumulated $142 billion in dry powder specifically for opportunistic pandemic investments by late 2020. This capital stood ready to purchase struggling companies, real estate, and other assets at crisis valuations. The pattern's acceleration revealed how technology and financial innovation had streamlined the extraction process. In 1929, it took years for wealth to concentrate as the Depression unfolded. In 2008, the cycle compressed to months. In 2020, billionaires gained trillions in mere weeks as algorithmic trading and instant liquidity allowed capital to flow toward opportunity at electronic speed. Government policy facilitated this velocity. The CARES Act provided direct payments to citizens, $200 per adult, while simultaneously removing regulatory constraints on corporate borrowing and creating multi-trillion-dollar lending facilities for businesses. The Federal Reserve even began purchasing corporate bonds for the first time in its history, directly supporting asset prices. Research examining private equity performance during COVID found that PE-backed companies proved more resilient than industry peers, accessing capital that competitors couldn't secure. This advantage allowed well-connected firms to gain market share while independent businesses failed. The pandemic accelerated industry consolidation as surviving players absorbed the customer bases of failed competitors. The extraction machine had learned to operate at maximum efficiency. Understanding these repeating cycles reveals uncomfortable truths about modern economic architecture. The system has evolved mechanisms that automatically transfer wealth upward during crises, and these mechanisms grow more efficient with each iteration. The implications extend beyond wealth statistics into the fundamental structure of American capitalism. First, consider the incentive structure created by bailout precedent. Financial institutions now operate with implicit government backing. Knowing that failure triggers rescue rather than bankruptcy, this moral hazard encourages risk-taking since profits remain private while losses become public. The pattern rewards dangerous behavior and punishes prudent management. Second, examine the compound effects of repeated wealth transfers. Each crisis concentrates capital further, giving elites even greater resources for the next downturn. Those who profited from 2008 used those gains to purchase pandemic-distressed assets in 2020. The next crisis will find them even better positioned, creating an accelerating feedback loop. Third, assess the political implications of extreme wealth concentration. As capital consolidates, political influence follows. The same elites who profit from crises shape the policies that govern those crises. Treasury secretaries come from Wall Street and return to Wall Street. The revolving door ensures that crisis management serves those who manage the system. The housing market illustrates where these trends lead. Institutional ownership of single-family homes barely existed before 2008. Today, corporate landlords control hundreds of thousands of properties, converting home ownership, historically America's primary wealth-building tool, into permanent rental income. An entire generation now pays rent to private equity firms that bought foreclosed homes during the last crisis. The Federal Reserve's expanded role creates new vulnerabilities. With balance sheets measured in trillions and asset purchase programs that directly support stock and bond prices, the Fed has become the ultimate backstop for financial markets. This creates an impossible dilemma. If the Fed stops supporting asset prices, markets may crash, but continuing support inflates valuations beyond sustainable levels. Private debt has reached historic proportions, with household, corporate, and government borrowing all at or near record highs relative to GDP. This debt exists because low interest rates, maintained to support asset prices, made borrowing irresistible. When rates eventually rise, or the next crisis arrives, this debt mountain becomes the fuel for another round of forced liquidations and distressed asset sales. The conventional narrative presents recessions as natural disasters that strike randomly, afflicting rich and poor alike. This story serves those who profit from the pattern by obscuring the mechanisms that enable wealth extraction. The truth contradicts comfortable assumptions about markets, merit, and economic mobility. Recessions aren't unfortunate accidents, but structural features that redistribute wealth through predictable channels. The system doesn't malfunction during crises. It performs its hidden purpose. What appears as failure is actually transfer. What looks like destruction is actually concentration. The machine works perfectly for those who built it. This recognition leads to an uncomfortable question. If elites profit consistently from economic crises, what incentive exists to prevent them? The pattern suggests that instability serves important functions for those who shape policy. Crashes clear out competitors, transfer assets to well-positioned buyers, and reset labor markets in ways that benefit capital over wages. The real scandal isn't that some investors make money during downturns through superior skill or foresight. The scandal is that the entire system, including government policy, central bank actions, and bankruptcy procedures, has evolved to facilitate wealth transfer from the many to the few during moments of maximum vulnerability. Understanding this pattern doesn't require conspiracy theories or villains. The mechanism operates openly through legal channels and public policies. Market participants respond rationally to incentives created by rules that protect capital while exposing labor and small businesses to full market discipline. The extraction machine is policy choice, not natural law. The most important insight is recognition that economic pain inflicted on millions during recessions doesn't simply disappear. That wealth doesn't vanish, it moves. Every foreclosed home, every liquidated stock portfolio, every failed small business represents value transferring from desperate sellers to patient buyers. The depression prices that devastate families create the discounts that generate fortunes. Future historians will likely identify this era by its signature characteristic and the systematic use of crisis as wealth extraction opportunity. We've built economic institutions that convert widespread suffering into concentrated profit with increasing efficiency. The debt extraction machine doesn't just profit from recessions, it requires them. And the next crisis, when it comes, will follow the pattern these cycles have established, unless we recognize what's happening and demand different rules for a system that has learned to harvest desperation as its most profitable crop.